thanks to IIT Chennai Incubation Cell for organizing such wonderful sessions. I have been following IIT Chennai for at least a quarter now, and personally, it has been a very exciting and very fulfilling journey. I've seen startups in a very, very complex deep tech space to all the way to soft tech, but amazing marketing mode or amazing solutions over there. So it has been very, very exciting for me. On the deep tech space, of course, we spend a lot of time on the deep tech space. Would love to talk at length someday about that. But today's topic, coming back to that, which is the finance and how to manage the financing around that. So I went through a lot of questions and a lot of wonderful questions that were shared before the session. So, and we will have an interactive session, but I thought what I'll do is I'll start by a structured framework that can actually control our thinking around the financing. And once we have put together our thoughts on the structured framework together, then we can do a question and answer or an open discussion. That will be I felt it will be a bit more productive. So before we talk about, so when we started with the theme, how to manage startup financing, I, together with two of my team members, Mehul and Piyush, who are also on this conversation, we sat down and we started talking about what are the important considerations or the important decisions that as CEOs of the startups we have to make, especially in the first, from day zero to the first 3 years or first 5 years of your company. And we bucketed them in 3 parts: equity, budget, valuation. Those are 3 broad financial topics that most of the questions that we often get asked fall in these 3 categories. In equity, the questions are around what is the co-founder split? Is the right split or not? Am I paying my co-founder too much? There is a non-working co-founder. Should I give him 20% equity because it was his idea? There is a person involved, and all questions around that. Then what is the share of others? How much money should be allocated how much stocks should be allocated to the ESOPs? How do we manage short-term financing for the salaries? What are the different compensation frameworks that we can use? Vesting schedule, how we should be vesting the stocks that we're talking about for the employees and the founders. Dilution analysis, how exactly we are going to dilute and when are we going to dilute? How much dilution to do at seed stage, Series A, and all the different stages. Then on the budget side, what should be the first year budget? What are the considerations that we should have? What are the considerations for the 3-year P&L projections? Because all the VCs, every time you start talking, they want to have a 3-year P&L projection or at least a 2-year P&L projection. So how do we think about it? Then on the valuation side, what should be the exit valuation and how we should be thinking about it? And on what is the size of the prize for the founders that we're looking at? Because practically founders are taking a massive risk by not probably going for a multi-million rupee salary and instead going for a startup which is highly risky. So what is the size of the prize we're talking about? So those are the 3 broad buckets: equity, budget, and valuation, under which we'll be going deeper into. I'm going to pause here before I will be going into each one of them and elaborating each one of them over the next 15 minutes. But any question, comments, thoughts on this framework or this thought? Cool. So I'll go factor by factor and we'll talk about that. So the first part is the co-founder equity split. Question is very typically, how do we decide how much equity different co-founders get? So it's a combination of multiple factors. It's a combination of whose idea was it? What is the contribution to the company that the person brings on the table? What is the opportunity cost, i.e. if this person decides to quit and move on, what is the opportunity cost we are talking about? What is the stage of company? Did the co-founder join from day 0, or did this person join from day 1 after 1 year, or at what stage did this person join? Or you can do simply a 50-50 or a 33-33 each split if there are 3 founders. But even though I say there are 4 factors: idea, contribution, opportunity cost, and the stage of the company, unfortunately, there is no right answer to this. Even if you look at the market benchmarks, how different startups have done historically, it's completely different from each other. There are startups where the value of the idea itself is very big, and there are startups where the idea or the value of the idea is probably 1% equity. Just because you came up with a fast food delivery doesn't mean that you will get 50% equity in the company. So it really ranges from a lot, because sometimes ideas also come after like decades of research. Now, there are certain best practices around the co-founder equity split. The split should be forward-looking. You should ideally be leaving probably like 15% of founders' equity unallocated, just in case we decide to bring a third co-founder at a later stage, or that unallocated equity can be allocated when you reach your first significant milestone, which could be like a MVP or the first customer or a first purchase order. The second best practice is be prepared for a founder's departure. And this is something that I feel a lot of startups do not worry about, but it happens very often. The company started with 3 co-founders or 2 co-founders, and one of them started to leave. So you need to prepare your vesting schedules accordingly, that in case someone decides to leave, what is the implications of that? And sign a non-binding agreement. It may not be a binding agreement, but at least a non-binding agreement forces all of us to think through it carefully, that what exactly we are getting into together. Again, I'm going to take a pause here and see if there's any reaction, comments, thoughts, or anything that anyone wants to talk about here. No. I'll move on to the factor 2 and factor 3, which is what is the share of others and what is the vesting schedule that we are talking about. Now, of course, there are some best practices which we are showing on the screen, that when you bring the senior hires, you should be giving probably like 5% equity. If you are bringing engineers, certain percent equity, service providers, what is equity, advisors, certain equity. But very important is that you can give ESOPs and all these shares that we're talking about, but there has to be a vesting schedule for each one of them. Even if it's just an advisor, even if this person is just a service provider, putting the vesting schedule gives them a long-term incentives and ties the company's or startups' success to their compensation. So they are incentivized to make sure that the company thrives in the long term. And we should be using vesting as pretty much like an insurance. And we should think about what is the duration of vesting we're talking about. So it's very normal to do a 3-year vesting or a 4-year vesting, and different vesting schedules are possible. What are the vesting styles? Do we need a vesting cliff, for example? Are we doing an accelerated vesting? Do we need some new financial engineering around the vesting schedules? Everything is possible. But vesting is your insurance against someone just taking a short-term equity and just moving on with life.
Chirag, there was one question in the chat,
okay,
which said that is there no hard and fast rule that one person should hold more than 50% of equity? Raghunath from Seratattva.
Okay, first of all, I don't think, and I'll be surprised if there is, to my understanding, Raghunath, there is no hard and fast rule that you must have more than 50% equity in the company. Having said that, yes, there are intrinsic benefits of doing that if you continue to hold more than 50% equity, or at least the co-founders together hold more than 50% equity. But if you think about it, most of the companies, when they hit Series B, up till Series B, 50% is very normal that everyone holds more than 50% equity in the company. But more often than not, at Series B, the founders will end up with less than 50% equity in the company, because they would have diluted and fundraised significant money against the equity valuation. And the only way is founders have to give away like dilute their own shares or own equity, and you'll end up with less than 50%. Does it answer your question, Raghunath?
Yeah, thank you, Chirag. It answers. I was just thinking like the shareholding equity also influences the decision making process, right?
Yes.
So if you have more than 50%, it also safeguards the company's interest in the long term. So
Yes.
I thought there is a hard and fast rule in place that you should have more than 50%. But yeah, thanks for the clarification.
There are two, I would say, milestones in the equity dilution. So one is the 50% equity dilution. The moment you go below 50% equity for founders combined together, you are at risk. You are right, but it's normal to lose somewhere around that. The second milestone is 15%, 15%. 15% is the bare minimum that I strongly recommend. Even if you do all the dilution, as long as you have not gone for the IPO, if the founders lose even 15% equity in the company, they are at a significant risk. So that's a second check that typically is relevant at a late stage of the startup.
Okay, thank you. Thank you for the clarification. Yeah, thank you.
I'll move on to the dilution analysis. This dilution analysis is personally very interesting to me. And let me explain the XY matrix. This is from one of the Harvard Business Review article. If you Google it, you will find this matrix. But let me try to explain in simple words, what does it do? Your x-axis is the financial gains that you as a CEO should be aiming to get. Do you want to have highest financial revenue, which is close to potential, or you're comfortable doing a below potential financial gains? And the y-axis, how much control do you want over the company? Do you want like a complete control or a little control over the company? Now, as you start growing and you start progressing in your startups, what will happen is that you start diluting, and as a CEO, you may be asked at a Series B and beyond that is the founder CEO really the right thing? Can you step aside and should someone else be the CEO? If that happens, you have little control over the company. But what may happen is that at Series, you might be the best founder for the company, but at Series B or beyond, or when the company is at the growth stage, you may not have the financial acumen. So you might choose to be rich by allowing the highest potential person to come and control the company, but you will have little control over the company by itself. Or you can be a king by saying that I don't care, I am going to learn the commercial aspect. The company might end up with a below potential, but you will have complete control over the company. What you should be conscious of not doing is you end up with a below potential, and you bring in someone who's stupid enough to bring the company to failure, or who drives you. You decide that I want to have complete control on the company, and I want to bring it to the highest potential, which is an exception because there are very few startup founders that can scale the company to the highest potential, what the company deserves to be. So when you start diluting as a CEO or the founders of the company, you need to start thinking about what are the financial gains, what are the implications of the financial gains, and what is the implication on the control that you as a founder will have on the company, and then make some choices around that. I'll move to the fifth factor, and in case there are any questions at any point, just pause me and or interrupt me. I'm happy to take them. On the budget side of it. Now, this is the illustrative first year budget only for the first year of how it looks like. For 0 to 3 years, 3 months, you should be talking about company registration expenses, pre-seed fundraising, and all those things. 3 to 6 months, you should be budgeting for MVP development. 6 to 9 months, seed fundraising, second hire or third hire, or the product launch. 9 to 12 months, you should be talking about traction building and trying to survive the company. From a first year onwards, the budgeting gets very complicated. And this is where the 3-year P&L projection comes in play, which is a way more complicated topic. When you start thinking about a 3-year P&L projections, you need to have a very clear view on what is the desired exit valuation that we are aiming for, and what is the exit route we are thinking about. There are few questions you should be discussing. There are 4 broad questions that you should be discussing internally to come up with a 3-year P&L projection. So the first one is, what are the major milestones? And major milestones could be a MVP, it could be a first customer, it could be the seed round, but you should talk about what are the different major milestones that you want or should be achieving in the next 3 years. Second is, what are the key metrics other than revenue that you want to track? Do you want to track the regulatory approval, especially if you are a biotech company? Do you want to track the number of readers of your blog or any other metrics that you're tracking? It may not necessarily lead to cash implications, but you need to know what metrics that you want to hit on a monthly or a quarterly or annual basis. Third is, what is a cash burn rate that you can manage over the next 3 years? Your cash burn rate will determine how much funding you will require, and you need to start working backwards on that. And fourth is the revenue. We put revenue at the last on purpose, because all of these things combined together often leads to discussion on, once you know the milestones, metrics, and the cash burn, you can talk about, okay, if these are the metrics that I'm playing with, what is the indicative revenue or the number of customers or revenue per customers I should be aspiring for? And more often than not, when you go to any venture capital firm, venture capital firms will do a driver analysis on your P&L, and they will go very, very, very deep on each of these 4 factors: milestones, metrics, cash burn rate, and the revenues. And you will be asked to justify, depending on which VC firm you're talking about, you will be asked to justify every milestone, metrics, and the cash burn rate, expenses, and the revenue, and a breakdown, a detailed breakdown of that. So that's the 6th factor we are talking about. There's a question in the chat. Should I address that now, Jaya?
I've just taken Manoj's permission that we can revisit that as soon as you're done, Chirag, since it's related to ESOP. Yeah.
Okay.
Yeah.
I can take if it's an ESOP question, I can. I haven't read it, but I can take the ESOP question now if you want.
Sure. So it's in the chat, Chirag. Manoj is asking if you can comment about the typical split between ESOPs allocated to founders versus ESOPs which are allocated to employees.
Okay, so let me first try to start by sharing some best practices around that. Almost all the companies that I know, they allocate 10 to 25% of their equity throughout the lifetime of their company as the equity dilution for ESOPs. Having said that, they don't start by saying that we will do a ESOPs of 25%. So this range is very broad, 10 to 25%. More often than not, what I have observed is they will start with a very small number, typically 8 to 10%. And with every round of fundraise, they'll start allocating more ESOPs over a period of time. In some cases where it's a very critical or it's a very small company, for example, WhatsApp, to my best of my memory, I may be wrong, they had 26 or 27% of equity in the ESOPs. Now, for the founders, I am not sure how to see founders versus ESOPs question. Can you elaborate a little bit, Manoj, on your question on founders versus ESOPs?
Yeah, sure. So typically, founders would have subscribed to the initial shares of a company and would hold certain ownership, right? But thereafter, you need to create some kind of a incentive structure for the founders also to contribute and drive. So I'm just trying to see if there is some broad guidelines around, and then you obviously have the key employees who you need to encourage. So is there some kind of a thumb rule or something which, in which how, let's say, a 10% gets split or something like that?
So when I said 10% of ESOPs, that does not include the any stocks for the founders. Founder stocks are typically outside that 10%. And when I said that it can go up to 25%, depending on which sector, what type of product, what type of company, the smaller the team and the more people in thinking team that we're talking about, especially like in the deep tech space, you can go up to a 25% of the overall pool into the ESOPs, which does not include founders shares.
Got it. Thanks, Chirag.
I'll move on to the last slide that I have, which is the exit valuation. Now, exit valuation and the size of the prize. So the exit valuation and size of the prize is a very interesting topic, because this is practically the reason that, and I'm not saying that everyone is building a startup for that, but everyone's in somewhere in their mind have that in their mind, that how I'm going to exit and how much money I'm going to make. Now, almost always you need to have a view of exit scenarios, and you need to start working towards them. Now, before I go into the critical assumptions part, when I say build towards them, the exit scenario, how you build a company towards an IPO versus how you build a company towards M&A, there are slight nuancing differences. So there are 4 key questions that kind of probably answer the question. The first is, which metrics do you have to hit to achieve an exit? Now, these metrics can be different for IPO type companies versus M&A type companies. And it of course differs from what product you're building, but you need to think about what metrics you're talking about. And once you have answers to the question that which metrics you're talking about, you yourself will be able to see that is IPO the long-term game, or is it a corporate acquisition a long-term game? Because some of the metrics are not loved so much by the institutional investors to be acquired, and some of the metrics are not loved so much by the retail investors who might be investing in the IPO. So once you have that answer, you'll be able to think through this. When can you hit the target metric? So that will give you a timing of a ballpark of the timing of the exit. Are we talking about 3 years, 2 years, 5 years? And most of the venture capital firms or the private equity firms, when you talk to, they will ask you this question: when are you going to hit the target metrics? Because they are working backwards on your exit. Eventually, even though they might pretend or they might actually love you and your startup, deep down, the venture capital firms, private equity firms are there to make money, and they'll make money from the exit. Question number 3, the venture capital firms will ask you, how would you exit? Is it going to be an IPO or is it going to be an M&A? And the 4th question that you will have to think about is, what's the typical industry valuation approach applicable to your business? You will notice that different sectors right now have different valuation approaches which is applicable. So in certain sectors, it could be some of the parts valuation. In some cases, it's a discounted cash flow. I'll not go into the details of these terms, but in some cases, it's a public comparables. In some cases, it's precedent transactions, which defines what is the valuation approach that is more prevalent in your particular sector. And once you have identified what is most commonly used as a valuation approach in your sector, you will be able to calculate 3 years from now or 5 years from now, what is the likely, based on the target metrics that I'm trying to achieve, what is the likely valuation going to be in 3 years or 5 years? And you should be able to communicate that number amongst your co-founders and also to the venture capital firms, because they are also trying to calculate the same numbers amongst themselves. So coming back to the overall framework, we talked about equity, 4 questions, budget, and the valuation. I'll stop sharing my screen now, and we can have like a open discussion, any topic. And I may not have answers to every question, but let's see if we can collectively answer some of these questions.